Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 24th November. Coming up on the show, markets are now more confident of a rate cut next month. I'll explain why. Amid a tricky time for AI, China is adding to the pressure for US AI giants. And why are European defence stocks falling? So grab your coffee and let's own the morning. The first thing you need to know is that the Fed rate cut hopes are rising. According to the CME FedWatch tool, the markets now think that a Fed rate cut stands at over 75%. Now, Wall Street looks like it's trying to extend Friday's bounce in the main, with the tech-heavy Nasdaq leading the way. Hopes for a Fed rate cut rose after Federal Reserve Bank of New York President John Williams suggested that a December rate cut remains a possibility. The next thing you need to know is that shares of Google parent Alphabet look set to continue rising. Google Cloud has just announced a multi-million-dollar deal with the NATO Communications and Information Agency to deliver AI-enabled sovereign cloud capabilities. Now, Alphabet shares have advanced in recent days following the launch of Google's latest AI model, Gemini 3, plus the recent news that Berkshire Hathaway has taken a stake worth more than $4 billion in Google, which has also helped. And the last thing you need to know is that American AI faces a fresh challenge from China. Alibaba's Qwen app drew more than 10 million downloads in the week after its relaunch. That kind of bodes well for a longer-term effort to build a rival to OpenAI's ChatGPT. Now remember, OpenAI's biggest backers are Microsoft and Nvidia. Now, Alibaba shares, unsurprisingly, are rising in the pre-market. Okay, we may have heard now from all the Mag 7 stocks, but there are still some earnings to watch out this week. But perhaps it's the economic data that will really take the spotlight. Here's Josh Lipton with What to Watch.
Time now for What to Watch. Next week will be shorter than usual as investors ditch their trading desks for the dinner table. To celebrate Thanksgiving, the U.S. stock market will be closed all day on Thursday, November 27th, and have a shortened trading session on Friday the 28th with an early close at 1 p.m. Eastern. On the earnings front, we're going to be getting reports from a number of retailers, including Kohl's, Best Buy, Abercrombie & Fitch, and Dick's Sporting Goods. And tech companies, they aren't done reporting either. On the software side, we're going to get reports from Zoom, Workday, and Zscaler. On the hardware side, we're going to hear from Dell and HP Inc. on Tuesday. Taking a look over the economic data, we're going to be getting some government-issued reports that were delayed thanks to that record-long government shutdown. On Tuesday, the September retail sales data will be released alongside pending home sales and the S&P Case-Shiller Home Price Index. And on Wednesday, initial jobless claims come through as well as that delayed September durable goods orders.
Well, to help us dig a bit further into what's coming up this week and much more, I'm joined by Russ Mould, Investment Director at AJ Bell. Russ, thanks so much for joining us. Well, let's start with the Fed. The probability of a Fed rate cut has now risen. I mean, last week I was talking about 30%, 33%, and now it's at 75% according to the FedWatch tool. What do you make of what we heard from the New York president, Bank of New York president there, and also whether you do believe the markets are now right to believe that we will get a Fed rate cut next month?
Yeah, I mean, Mr. Williams is clearly being very pragmatic. We are starting to catch up on the information that we've been missing for the last couple of months owing to the US government shutdown. And although opinions remain split, it does seem as if there is some slowdown in the US jobs market. There is some cooling there. You can see that in vacancies, weekly claims, and you can see that also in the non-farm payrolls data. We'll get a lot more of that on Friday. But there's probably just enough justification in there for the Fed to at least consider cutting. And it's not just cutting this month, but if you look at the CME FedWatch surveys that you quoted, that's pricing in at the moment, or factoring in something like 3% rates by next Christmas. So that's a full percentage point below where we are now.
Now, one of the key themes last week, and has been for a while now, is worries about an AI bubble. We saw a bounce back on Friday, but do you think those fears of an AI bubble, they're still around, aren't they?
Very, very much so. And there are more questions being raised about funding for this phenomenal amounts of capital expenditure planned by the hyperscalers companies, $420 billion this year, $500 billion, then $600 billion in 2027? Will there be a return on that investment, given that I'm sure Chinese competition isn't going to sleep on that, even if there is substantial adoption? And then where do we sit with valuations? Again, when Nvidia's market capitalization reached $5 trillion, same as the GDP of Germany, that does say an awful lot of value that's being provided by the 36,000 Nvidia employees compared to 84 million Germans. And Nvidia's results were impressive, but there were some holes that you could pick in them in terms of the cash flow, inventories and receivables, and that came back to the funding issue. So that's probably going to be the biggest area of focus in the next one or two Nvidia quarterly numbers.
Now, so we've talked about the Fed, we've talked about the bubble. The next thing I really want to talk about is Black Friday, because we heard from a lot of retailers last week, kind of a mixed bag. Walmart was clearly the standout there, but what are your hopes for Black Friday?
Yeah, I mean, Home Depot popped out a stinker at the same time. So again, we're still seeing a very, very bifurcated consumer. Even if you look at the official statistics, University of Michigan surveys down at levels below that we've seen in the last 5 or 6 US recessions. The Conference Board survey isn't that bleak, but it's well off the peak of last November when the president was elected and way below the peak seen during his first term in office. So there are signs that some American consumers are feeling the strain. You're seeing that in some of the subprime areas particularly. But again, it's a very K-shaped economy, you could argue. Those at the top are doing really well. They've got assets. Those further down the pipe are feeling a lot of pressure from inflation. And we saw that politically in the November election results as well. So I think you will see a very, very mixed set of results from retailers. But at least one thing you might argue is that Black Friday is normally pretty good for a discount. So it's up to the retailers to manage that appropriately and preserve margins as well as generate cash flow.
I'm not going to get into your shopping list now, but let's look at earnings as well. We've got John Deere, their results out on Wednesday. It's fair to say sentiment amongst farmers isn't that great right now. Am I right?
No, it is. And I think the presidency has been responding to that with some of the trade deals we've seen with other countries. But equally, Deere's numbers have been reflecting that. The last set of numbers back in August weren't very strong. Analysts are predicting a double-digit percentage earnings per share decline for this quarter and for the year as a whole. I think their secret will be much more what's the company seeing going forwards in terms of backlog and also in terms of tariff impact. They'll be shaping the numbers for the coming year when analysts do expect a 7-8% improvement in earnings per share across the year as a whole.
Russ, I'm afraid that's all we've got time for today, but many thanks for joining us here on Yahoo Finance. Okay, it's time now for a short break, but when we're back, my colleague Jared Blickery will have a closer look at volatility. You won't want to miss that. Welcome back. Well, it's time now to hear from Jared Blickery for another instalment of Stocks in Translation. This time he's helping us understand market volatility and options expirations.
Markets have been unusually volatile recently, as unpredictable and erratic as the weather itself. And when the sky flips fast, you check the weather forecast. And in markets, that forecast is the VIX, which is exactly what we're breaking down on today's Stocks in Translation, along with options expiration, which is adding another dimension of odd wonkiness to market behavior. First, let's dig into the VIX, also called the CBOE Volatility Index. This is our main weather gauge for the market, and it's calculated on options that trade on the S&P 500 about 30 days out. Now, most retail investors operate on a much shorter time frame than that in the options market, so the VIX is more a measure of how much protection big money on Wall Street is buying. As Interactive Brokers Steve Sosnick likes to say, don't call the VIX a fear gauge. The VIX is not necessarily based on emotions. And when these big investors rush to buy protection, they're seeing some weather patterns that might not be visible on the horizon. And when they buy en masse, the VIX spikes, just like a storm warning might light up your weather app. There's also a seasonal weather pattern to the VIX. It tends to be higher on average in October and November, as that's when we've seen some big swings historically. Now let's take a look at how the storm warning has changed over time. And we got a chart here of the VIX going back to the beginning of the year. So this is year to date, and we're putting on a 50-day moving average as well. That is showing up in blue. This smooths the VIX's choppy and spiky price patterns. And you can see that big spike around Liberation Day in early April, earlier in the year, and recently we had a spike in mid-October. That was a China tariff scare. Now the current spike just got a little bit bigger than that, but not nearly the size of that April spike. So we're only expecting some squalls now, not a hurricane, though that can change quickly, just like the weather. Now look at that 50-day moving average and how it formed a sort of ceiling for the VIX after it calmed down in May. The VIX started using that average as a floor. That was a signal that the market patterns were changing, and we might expect more storms than usual, even on days and weeks when the sun pops out. So now let's talk options expiration, or OpEx, and we have a handy guide for that right here. These days, we have options expiring every day of the week, but on the third Friday of each month, and that's November, that's the 21st, we have the monthly options expiring. And this is the one that you can see bigger market-wide effects at times because there's a lot of money's worth of options expiring. Now, investors can buy options on indexes like the S&P 500 and individual stocks, plus ETFs and futures, but index options usually settle at the market open on Friday, while the others usually stop trading after the market close. Some of the heavy selling that we saw during the week was due to the buildup of index options around certain prices. But as these bets and hedges roll off on OpEx day and new contracts are written, this can be a sort of reset for the market. Sometimes we also get some quirky activity on options days, but usually the indexes have lower volatility than usual. This happens as big stocks get pinned at certain price levels because of their own options activity. Suffice to say, there's a ton of math involved and options are not for everyone, but it is helpful to know when there's a possibility of a squall forming out of the blue. So how do we use all of this heading into Thanksgiving week? First, we want to watch the market weather patterns and what they actually are. Do daily stock swings start to shrink, or do they stay big? What tells you whether the weather storms are moving out or still rolling through? Then you got to watch the weather forecast. Does the VIX itself ease back down? That suggests that demand for protection is fading. Or does the VIX stay high, which shows that higher demand for protection by Wall Street is there? And by pressing that a little bit further, we can also ask how the VIX is reacting around those recent highs and lows and how it behaves around that 50-day moving average. Is it spending more time above or below it? Because that can tell you when the forecast is changing. It takes a while for the VIX trend to change, probably a little bit longer than a holiday-shortened trading week, but if you keep an eye out on the VIX regularly, you'll learn to start some early changes in its behavior. And the good news is, you can do all of this easily with the Yahoo Finance app or website. So tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Well, it's time now for another quick break, but stay locked into Market Sunrise for today's trending stocks, including some pharma names, some defense names, and also some tech names too. Time now to look at stocks that are trending. First up, European defense stocks have been rallying this year. But not today. As hopes for a peace deal between Russia and Ukraine grow, companies like Rheinmetall, Thales, BAE, Babcock International are all seeing a sharp reversal. The defence sector, which has been rising on expectations that military spending in Europe would only keep going up and up, well, it slid more than 0.6% this morning after a 3.4% drop on Friday. So watch this space. The Ukraine defence tailwind might be shifting. Now, if you follow this show, you've heard about WeRide, the Chinese autonomous driving company that's now exporting robo-taxis around the world. Well, it may not be profitable, but it's having a strong rally today, recovering some of its losses so far this year. That's thanks to Q3 results that showed a 144% increase in revenue, with robo-taxis seeing the strongest momentum. Keep in mind, it's still a highly speculative position in a competitive market, and the company is burning a lot of cash to fuel expansion. Finally, you must watch pharma this morning after Eli Lilly became the first $1 trillion company in the sector thanks to its leadership in obesity drugs. There's another giant, this one from Germany, that's finally seeing signs of a turnaround. Bayer is rallying in morning trade thanks to its cardiovascular pipeline, and specifically thanks to progress in clinical trials for a new stroke prevention drug, up 11.5% there. On the other hand, end of the spectrum though, Novo Nordisk's trial results on Alzheimer's drugs were underwhelming, and the markets are selling the stock fast. Look at it, down almost 10%. So that's yet another challenge for Novo Nordisk after a very difficult 2025 so far. And there's no ticker out there that's been trending more than Nvidia. Strong earnings haven't been enough to prevent an AI sell-off last week. Now Nvidia's prospects in China are offering hopes for investors, as the US is considering allowing the sale of some relatively advanced chips. Our tech editor Dan Howley reacted to the news on Friday.
Yeah, Josh, this would be huge if they were allowed to move forward with this move. This is not the highest end NVIDIA chip. This is the H200 based on the Hopper architecture. You recall right now, NVIDIA is shipping products based on the Blackwell architecture, their Blackwell and Blackwell Ultra, and then they'll have their Rubin architecture coming up after that. But this would allow them to start shipping higher end chips into China if this ever comes to fruition. It's not necessarily set in stone or anything. It seems as though, according to the report, they're just discussions. Right now, they're only allowed to ship the H20, which is a degraded version of the Hopper architecture, into China. And China isn't even taking those right now. This is all part of the ongoing back and forth between the two countries. Should the U.S. allow these kinds of high-end chips to go into China? The Trump administration has seemingly been leaning towards that, having discussions with CEO Jensen Huang. NVIDIA has been pushing for this. They say that if they can ship their chips into China, it would give the U.S. a leg up because the Chinese developers would then be reliant on U.S. technology. Jensen Huang also says that nearly 50% of the world's AI developers are currently in China, and so it would behoove the U.S. to kind of take advantage of that. But there are those in Washington who say that giving the technology to China would ultimately be a bad thing for the U.S. because Chinese developers could potentially work with the Chinese military, and then that could give them a larger lead in AI or a lead in AI over the U.S. And so there's this constant back and forth and friction between whether or not they should ship or shouldn't ship, and if they do ship, what they would ship, whether it's the H20 or the higher end H200. Previously, we had heard talk about potentially Blackwell chips being shipped. That would be an even larger move than this.
Daniel, it's interesting because, as you pointed out, the H200, right? It's not the latest and greatest. It's not Blackwell. It's sort of like if Trump, I feel like, he told Tim Cook, he says, you know what, Tim, I'm feeling generous. I think I'll allow you to ship, the iPhone 14 to China. The iPhone 17, that stays here. The iPhone 14 can go. And I do kind of wonder, Dan, well, let's say this happened. How do you think the Chinese would respond and react if the H200 was permitted? I mean, how do you think Xi would feel about that? How do you think the Chinese companies would feel about that? And I guess what I'm really asking is how the H200, do we know how it compares and contrasts, for example, with Huawei, the performance gap?
Yeah, that's actually a good question. I don't know what that gap is like, although I will say that, when it comes to the Chinese government itself, they've been kind of telling companies to rely on homegrown chips, and they've been pushing for the likes of Huawei to make chips that are as capable as NVIDIA's. Now, that's not as easy said as done. We have AMD here, obviously globally, but it's a U.S. company, and they produce chips as well for AI data centers, but, they might not necessarily be up to snuff when it comes to what NVIDIA has to offer. And don't forget, NVIDIA also has its software, its CUDA software, which gives it a leg up as well. So, it's hard to say whether or not the homegrown chips in China would be able to catch up with NVIDIA. There's a reason why they're the leader in this space. They invested very early in this when nobody thought that there was any point in doing so, and it's paid dividends clearly from their revenue and a market share. But I think one of the things to think about is that with the H20 being a degraded version, there is the ability to kind of surpass that. The H200 is a higher end version chip, but again, it's not based on the Blackwell architecture, the latest architecture. So it's not really, a one-for-one when it comes to, getting the Blackwell and then getting this. This may not be exactly what, Xi Jinping wants.
So earlier I mentioned that economic data out this week could be more relevant than some of the earnings results we get. So why is that data could make a big difference to your mortgage? Well, the 30-year mortgage rate, according to Freddie Mac, stands at 6.26%. Now, historically, if the markets feel the Fed rate is coming in the weeks before a rate decision meeting, then mortgage rates, they also start to fall too. Now, as a result of the government shutdown, data, though, is playing catch-up. But the release of this crucial information is now starting to pick up steam. Number one, inflation data in the shape of producer prices for September is sure to make a difference to rate cut expectations. Remember, a key mandate of the US Central Bank is to promote stable prices. Now, the lower the number, the more the chance of a rate cut. Number two, retail sales data is also due out. It's a key gauge of consumer confidence. Again, a low reading will make it more likely we'll get a rate cut. And number three, consumer confidence reading for November. And you've guessed it, a lower than expected reading. Well, that's also likely to increase hopes for a rate cut. So we'll be watching very closely on Yahoo Finance for the release of that data and perhaps some good news for your mortgage payments. Okay, now before we wrap up specifically on consumer sentiment, last week was a big one for retailers, and one of them, Gap, certainly pleased investors with its performance. The CEO of Gap was on Yahoo Finance to talk about his plans for growth after a difficult phase in which the brand has closed many physical stores.
Stores are incredibly important to us, but what we really think about is our consumers, where they are, where they're going, whether it's in stores or through a digital dialogue. And we're focused on cultivating what I would say is the best experience across every touch point that our consumers are in. So when we look at our fleet today, we have a very strong fleet of about 2,500 doors. We are at a pivotal point. We have been pruning and optimizing our retail footprint. We're now in a precision point where we're looking at new concepts, new doors, refresh models, and we believe that it's going to be an exciting chapter. We're always optimizing our retail footprint. We're always looking at repositioning, in some cases, on locations that we believe are more relevant to our customers. We're evaluating new store openings. And last year, I think we closed about 56 stores across our portfolio. We probably have another 35 this year. And now we're at a really exciting point where we believe we've got some incredible opportunity for growth from a store perspective, and certainly our online business has been performing very well.
Okay, before we go, let's check in on the markets. So let's start with Bitcoin and gold. Now, Bitcoin, it actually fell, as you know, last week below $81,000. It's up a little bit from those levels now, but still down on the day, down almost 1% at just below $86,000. Let's move on to gold. It's a bit steadier gold, in perhaps hopeful that we could get a Fed rate cut next month. A little bit stable, still slightly down. Let's move on to Asian markets now. And it was a bit of a mixed session in the region. You may have noticed there's no Nikkei on there today. Japan was closed for a public holiday. Hong Kong's Hang Seng getting a lift, not only from the Fed rate cut hopes, but also tech stocks getting a boost too. Okay, and let's have a quick look at the US markets now as well. And the Nasdaq in everything in the green right now as well. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.